It's pretty wild to think that in just 1 year, the entire world of flexible accommodation got completely redrawn. Fortunes were lost, giants came crashing down, and a whole new set of winners just emerged from the chaos. So, how on earth did it all happen? Well, let's get into it. This is a story of collapse, consolidation, and a total rewriting of the rules.
Okay, so how does a company, one that's valued at a whopping $2.2 billion, just collapse? Practically overnight? This is the big question, right? And listen, this isn't just a story about one company having a bad day. Nope. This is about a deep, fundamental flaw in a business model that a lot of very smart people thought was the future. This one question, it really opens up a much, much bigger story. And we're not talking about some slow, gradual decline here. No way. 2025 was a straight-up year of reckoning. The market basically turned into this giant centrifuge, just spinning so fast that it brutally separated the winners from the losers. The heavy, bloated, unsustainable models got thrown to one side, while the light, agile ones came out on top. And the results? Whoa. They were dramatic and, well, final. All right, Section 1, the Great Accommodation Collapse. So let's start with the wreckage, right? Because to really get who won, you first got to understand who lost, and maybe more importantly, why they lost so spectacularly. Okay, so this is the absolute key concept right here, the asset-heavy model. You could almost call it the original sin for all the companies that went under. Just picture this. You go out and sign a 10-year lease on, say, 100 apartments. You're on the hook for that rent every single month, no matter what. Your entire business now depends on you renting those places out night after night for a profit. But what happens if travel suddenly slows down or stops? See, your revenue can go up and down like a yo-yo, but your biggest cost, that rent, it's locked in. It's fixed. And that, my friends, is the asset-heavy trap. And the poster child for this whole model? It was Sonder, a huge name in the short-term rental game. They had this massive $2.2 billion valuation, and then it all just came crashing down. And I'm not talking about a restructuring or some fancy buyout. We are talking Chapter 7 liquidation. Game over. The end of the line. That total reliance on those master leases, it became a giant anchor that just dragged the whole company right down to the bottom of the ocean. But here's the thing, Sonder's collapse wasn't some freak accident. It was actually the most obvious symptom of this really deep structural split happening in the industry. And that brings us to our next section, a tale of two models. This is really the core of the whole story. So this slide, this really just lays out the battle lines perfectly. On one side, you've got the old way. Think of companies like Sonder or the massive manager of Vacasa. We're talking huge centralized operations with enormous payrolls and these just crushing long-term leases. But on the other side, you have the new way. This is the decentralized asset-light approach. Think of a franchisor like Casago. They're nimble, they rely on local partners, and they use smart tech to keep their overhead super, super low. It's really like a giant, slow-moving battleship versus a whole fleet of agile speedboats.
Okay, let's break this down a little more, because the flaws were slightly different but led to the same place. For Sonder, it was simple. That master lease model was a ticking time bomb. It was just a matter of when. For Vacasa, it was a bit different. It was their huge centralized workforce. They probably thought having thousands of employees on salary was a sign of strength, an asset. But the market? The market saw it as a massive liability. So when Vacasa was eventually sold off, the buyer wanted its inventory, the properties, but they did not want its expensive, bloated operational structure. And that's the key takeaway right there. Just being big, scale, meant absolutely nothing if the model wasn't sustainable.
So, while all these giants are crumbling, what's happening on the other side of the fence? Well, the companies with that asset-light model, they weren't just sitting back and watching. Oh no, they weren't just surviving the storm. They were actively circling, getting ready to pick up all the valuable pieces for pennies on the dollar.
And here it is. This is the winning playbook, and it was executed perfectly by Casago. Step 1, they swoop in and acquire that massive 40,000 property portfolio from the failing Vacasa. But, and this is the genius part, instead of trying to manage it all from some huge central office, they immediately go to step 2, decentralize. They hand over management to local franchise partners, people who actually have skin in the game. And then, step 3, they tie the whole thing together with top-tier technology. This standardizes everything, making the whole network super efficient. It was an absolute masterclass in smart consolidation.
So this huge shift, it wasn't just about companies having good or bad business models. There was more going on. It was actually being driven by three really powerful interconnected forces that were reshaping the entire investment landscape. And if you want to know where this industry is going next, you've got to understand these three forces.
Here they are: capital, technology, and regulation. The best way to think about them is like a three-legged stool. If any one of those legs gets wobbly or out of sync, the whole thing just falls over. And what happened in 2025 is that all three of these forces shifted at the exact same time. And that completely changed the game. It changed who could get funding, who could operate efficiently, and heck, even where you were allowed to operate at all.
So, let's follow the money, shall we? Where did the smart capital go? Well, check this out. Big private equity firms like General Atlantic, they stopped betting on the property managers themselves. Instead, they started betting on the software that runs those managers, backing the operating system layer, like Hostaway, for that sweet, high-margin SaaS revenue. Then you had other investors like Westcap who were literally funding the pivot, helping companies like Blueground get out of that asset-heavy trap and into a more efficient franchise model. And then you've got sovereign capital just building entire tourism ecosystems from scratch. The big takeaway? The money got a whole lot smarter and way more strategic about where it was placing its bets.
And if you look at the tech investments, the story gets even clearer. I mean, look at Hostaway with a $1 billion valuation. That tells you that property management system is now viewed as the core operating system for this entire industry. But look closer at the smaller bets. That $12.7 million for a company called Boom, that was specifically to build AI that could automate 80% of all guest communication. The message here could not be clear. Investors are pouring money into technology that directly replaces expensive human headcount. It's all about automation.
Okay, listen up, because this quote right here, this might be the single most important takeaway of this entire explainer. Regulation is now the #1 determinant of who can scale. After all our talk about smart capital and fancy tech, it all boils down to this. You can have the best business model in the world, you can have all the money, but if you're trying to operate in a city that suddenly decides to ban your business, you're done. It's over. Regulation has become the ultimate gatekeeper. And what this does is it creates this starkly divided world for real estate. On one hand, you have the green light markets. Think the US Sunbelt, Dubai, parts of Mexico. Places with predictable, friendly rules that just attract capital like a magnet. But on the other hand, you have the red light markets. New York City, Barcelona, parts of Australia. These are places where regulatory uncertainty and straight-up crackdowns repel capital. It's simple. Where your properties are located is now a direct measure of your risk.
So, given this new landscape, where there are all these risks and opportunities, where does the smart money actually go? Investors have become surgically precise. They're not just throwing money at the whole sector anymore. They're targeting very specific, defensible niches that look ready for profitable growth.
Well, for one, the luxury segment has become a total safe haven. And it makes sense when you think about it. First off, these high-end properties are usually in markets with way friendlier regulations. Second, you can charge a real premium for that top-tier service. The owners you're dealing with are wealthier and less price-sensitive, and the demand from renters is just much less volatile than the mass market. It's basically the premium profit center of the whole industry.
And if you want proof, look no further than the funding. $50 million. That's a funding round for a luxury brand called Sonder in 2025. I mean, that is a massive vote of confidence from big institutional capital. It's the clearest signal you can get that the smart money sees the high-end market as a very stable and very lucrative place to park its cash.
And then there's this other sweet spot that people are calling the Goldilocks zone. We're talking midterm rentals, or MTRs. Think anything from a 1-month stay up to 9 months. It's just right because you're getting higher revenue than a standard long-term lease, but you're avoiding all the regulatory nightmares and the crazy operational headaches of short-term vacation rentals. It's this perfect strategic balance, and yeah, investors find that very, very attractive.
Okay, so after this absolutely insane year of change, what did we learn? The dust has pretty much settled, and a brand new rulebook has been written. And the profiles of who wins and who loses from this point forward, they are crystal clear. Let's get into the new rules of winning.
All right, here it is, the final scorecard. The new winners, they're the local first networks. They're powered by AI-native software. They're luxury brands and hybrid living platforms. The losers, they're the old, centralized mega operators. The folks stuck in mass market, urban short-term rentals, the asset-heavy models, and any software that doesn't have AI at its core. It's really that simple now. If you're not using AI, you are already falling behind.
And look, if you take away only one single thing from all of this, please make it this quote. The key valuation driver has irrevocably shifted from growth to efficiency. For years, the only question investors ever asked was, how fast can you grow? That's it. Now the first question is, how profitable are you? The entire focus has shifted permanently away from just getting big to being smart, efficient, and sustainable. Efficiency is the new growth.
And that brings us to the final big question. And this really goes way beyond just real estate. In a world that's changing so fast, with so much economic uncertainty, we've seen that chasing growth at all costs can be a fatal strategy. The real challenge, the real goal, is to build something that's resilient and efficient. So you have to ask yourself, is your strategy just built for a moment, or is it truly built to last?